Hello, this is Mr. Bergman, and I'm going to give you a brief overview for the Chapter 8 test and what to expect. Part 1 is going to be identifying accounting concepts and practices. It's going to be a series of true and false questions worth 12 points each. The big meat and potatoes of this whole entire example is Part 2, where you're going to be journalizing and posting, adjusting and closing entries, and also preparing a post-closing trial balance. Part 3 is where you're going to be analyzing, adjusting, and closing entries, and that's going to be 9 points for a total of 60 points. So let's get started and take a look at some questions. So question number 1 here says, preparing a worksheet at the end of each fiscal period to summarize the general ledger information needed to prepare financial statements is an application of the accounting concept accounting period cycle. Well, when you're preparing a worksheet, you got to remember it goes through this whole entire accounting cycle. And it starts with analyzing transactions, then journalizing, then posting, then preparing a worksheet, then financial statements from the worksheet, and then we do the adjusting entries from the worksheet and closing entries as well. Once we do that, we post them, and then we prepare what is called the post-closing trial balance. So that is the accounting cycle. So when you're preparing a worksheet at the end of the fiscal period to summarize all the general ledger information needed to prepare the financial statements, that is true. You definitely need that. This next part is an application of the accounting concept accounting period cycle. Absolutely. I just described the accounting period cycle to you. It says a source document is prepared for adjusting entries. We know that that is false, and the reason why is because when you prepare adjusting entries, you have to title this on a brand new journal page, and there's no document number over here. The reason why you provide a title is because it's coming from the worksheet, so technically the worksheet is not a source document. All right, let's go to another one right here. It says the ending balances of permanent accounts for one fiscal period are the beginning account balances for the next fiscal period. That right there is true, because if you remember, permanent accounts always have a balance. It's very, very important to remember that. So cash is a really great example of an account that is a permanent account. It may have a $10,000 balance on October 31st, the end of the fiscal period. At the beginning of the new fiscal period, November 1st, it's still going to have that $10,000 balance. All right, so here's the next one right here. It says at the end of the fiscal period, the balances of temporary accounts are summarized and transferred to the owner's capital account. That is true, and here's why. When you go through and you are closing sales, we take $6,233 and we're putting it into income summary. We're doing the same thing with all of our expenses here, and they total up to $3,260. When you look at the actual account of income summary, and I go right here in the ledger, and I look, this is the sales amount right here, $6,233. This is the expense amount, $3,260. And if you follow over here their balances, the difference between these two numbers is $2,973, the net income amount. To close this out, remember what we do is we close income summary with a debit of $2,973 because it has a credit balance, and we put this right here in capital, $2,973. I'm going to skip this one here, and I'm going to go to the next one. It says journal entries used to prepare temporary accounts for a new fiscal period are called closing entries. That's true, and the reason why is because temporary accounts, if you remember from this previous question right up here, this is why I didn't answer it, they have to be closed and they have to have a zero balance so that they can start the new fiscal period with that zero balance. So that would be true. All right, to close a temporary account, an amount equal to its balance is recorded in the account on the side opposite of its balance. Well, that is true as well, and here's why. If you go to advertising expense and you look, advertising expense has a debit balance of $800. To close it and make it zero, you have to credit advertising expense for $800 because opposites subtract, and that would equal 0. You'd also put a 0 over on here as well. All right, here's another one. The income summary account has a normal debit balance. That's false. As we know from the Mastery Problem 8.4, you could have a debit balance for income summary, or you could have a credit balance with income summary. It's the only type of account that doesn't have a normal balance side. All right, this next one here says the balances of expense accounts must be reduced to 0 to prepare the accounts for the next fiscal period. That is true. Once again, that's the same as saying closing entries. These are all of your expense accounts right here, and to make them 0, we have to credit them. All right, let's take a look at another one. The drawing account is a permanent account. That is false. And the reason why it's false is because that's part of our closing segment right here that you see. If you remember the acronym that I gave you, we're going to close revenue accounts first, then expense accounts, then income summary, and then drawing. So all of these are called temporary accounts, and they have to have a 0 balance at the end in the beginning of the fiscal period. All right, let's take a look at another one here. It says the capital account's new balance after closing entries is verified by checking it with the amount of capital shown on the balance sheet at the end of the fiscal period. That is true. Number 12, a post-closing trial balance verifies the equality of debits and credits in a general ledger after the closing entries are posted. That is true as well. If you remember going to prepare a post-closing trial balance, we would list only accounts with balances. We'd put all the debit balances in this column and add them up, and we'd put all the credit column balances here and add them up. And technically, we'd put a single rule all the way across to make sure that our debits equal our credits. That's the last thing we do in the accounting cycle. If you remember, we talked about how you analyze transactions and journalize, then post, prepare a worksheet, then prepare financial statements, journalize and post adjusting and closing entries, and then prepare the post-closing trial balance. All right, so let's move on. So this right here is another portion where you're going to have to prepare adjusting entries, closing entries, and a post-closing trial balance. This is an example that you may see on the test, and something to help you out is that it doesn't give you letters. So this normally would have a letter right next to it. To help you on the test, just remember the very first entry. It doesn't matter if it's a debit or credit. This right here is going to be technically your letter A, all right? So when we're doing the adjusting entries, just keep that in mind. So to prepare adjusting entries, remember you have to put a title up here called adjusting entries. You have to put your date right here, okay? According to the directions that you see, it is going to be October 31st, and then you put the debit entry first, so supplies expense. Okay, so I'll put October 31st. I'll put supplies expense and the corresponding credit entry with supplies. Okay, remember for the post reference right here, that's when you post. There's no source document. We'll put $600 here. Debit entry always goes first, and then the credit entry goes second. You do that same thing for your other entry. Don't forget to post. So that's very important. You'll find that there's a general ledger right down here to post. So if I went down to supplies expense, obviously I'd put the dates down. I'd put down the page where I got everything from. I would put the $600 right here. If there's no balance, it automatically becomes a $600 debit balance. All right, the other thing is that the next thing we would do is we would prepare closing entries. Remember, closing entries are always for your temporary accounts. And remember the acronym that I told you. Revenue accounts come first, then expense accounts, then income summary accounts, and then drawing. So remember, read. Okay, so for example, where do I get that information? Well, probably the easiest place to get that information is from your ledger. If I look right here, I have a credit balance for sales of $3,200. So I'd put the title closing entries. I put down October 31st. I'd close sales by doing the opposite. Okay, so opposite subtract. So I would debit sales for $3,200. And I'm going to put that amount into income summary. Remember, income summary is our temporary account, and its only purpose is to help close these temporary accounts. Okay, so I put down $3,200. All right, now the next would be expense accounts. Remember, expense accounts are obviously debit balances. This one doesn't necessarily have a balance, but let me find you one that does. It would be closed with a credit of $385. Remember, you'd list all of your expenses below, and you'd list up here income summary first, because what we do is we actually close all of our expense accounts and we debit income summary. All right. When you're posting, remember to post after every type of transaction right here. So sales and income summary, you'd post this first, then you'd post all of your expenses, because you're going to need that for the income summary, which comes third. When you post to income summary, you're going to need to figure out what your balance is, and you'll have two postings right here, which will help you close income summary. The last thing that you would do, remember the D, is to close drawing. Drawing has a debit balance of $2,000. So in order to close this, you would credit $2,000 and you would put that into capital. The last thing that you do is prepare a post-closing trial balance. So this right here is the name of your company. You'd put down post-closing trial balance. You'd put the date down, and then you'd put all of the accounts that are permanent. Remember, they all have a balance. They're usually assets, liabilities, and owner's equity accounts. And you're going to list them, and you're going to list whether they have a debit or credit balance. So probably the most common is cash. So cash right here, if I put this down, I put cash, and then it has a debit balance right here of $10,200. I'd list all of my accounts down here and then add them up. And whatever the total is, let's say it's $30,000, okay, my debits have to equal my credits. Another part of the test would be fill in the blank. So you're going to have to go through and talk about, the journal entry to adjust supplies. You would remember that you would have to debit supplies expense and credit supplies. Another question you might see here is, after the adjusting entries for supplies has been posted, supplies expense has an up-to-date balance, which is the value of supplies during the fiscal period. Okay, so remember that when you start off a fiscal period, you start with a certain amount of supplies, and when you use that up, that number may be a little bit lower than what it started off with. After you make that adjustment, that right there is the actual adjusted balance. And the third one here, it says accounts used to accumulate information from one fiscal period to the next are known as permanent accounts. Obviously, the opposite of a permanent account is a temporary account, and that begins a fiscal period with a zero balance. One final concept I just want to remind you of is the whole idea of income summary. So for example, if this is the income summary account, and let's say that the income summary account has a $15,000 balance, okay? If income summary has a credit balance, that means that this is referred to as net income. Okay. Now you may be saying, well, why is it net income? Well, here's why. When we close that out and we put it into the capital account, I'll just put cap for capital. We close this out right here with a $15,000 debit entry. Okay, so income summary would be debited for $15,000, and then this would equal zero. And then the corresponding capital entry, let's say that capital has a $30,000 balance, okay? When you credit capital for $15,000, there we go, you get $45,000. So that's if it has net income balance. However, sometimes what will happen is that income summary doesn't necessarily have always a credit balance. In fact, it could have something completely different because there's no normal balance side for income summary. So, for example, if income summary here has a $10,000, I'll just put 10K, $10,000 debit balance, that means that this is referring to a net loss. And here's why. Because when you close this out, you're going to credit income summary for $10,000 so that it equals 0. And you're going to debit capital for $10,000. If you remember, opposites right here, subtract. So when opposites subtract, you're going to have a $20,000 balance, and that's why.